I'm going to start this week with tariffs are gone. On Friday, Supreme Court 6-3 decision. The executive does not have the power to use tariffs in the way that they were using it. And later that day, tariffs came right back, 10%. And then the next morning, raise them to 15, because why not? I guess he was unaware that he could go to 15% under Section 122, but only for 150 days. He's going to have to use other sections and other acts to get this done. So I asked DeepThink what he is likely to do. I asked 3 questions. The likely path the administration will take to keep tariffs in place beyond the 150 days. And I did this on Friday night before I knew they were 15%. I thought they were 10% because I had written 10% in here. The likely path the administration will take to increase tariffs beyond the 10% and the likely effect on the willingness of other countries to negotiate. And it was busy. So it told me to come back. So I said, well, I'll try now. And it said, I'm busy. Well, why don't you come back? So I said, I remind you, I am an ultra subscriber and show thinking. There you go. Sometimes, you got to be the bad guy. You don't want to be. You don't want to remind people. But sometimes you got to. So this is the fact check. Yes, it was right. The part that I wanted fact checked was in the prompt. I said 10% tariff on every country. Fact check this, and I think it fact checked the 10% and not on every country. So I'm not sure if it's on every country, including the island with the penguins. I'm not sure, but there we are. Likely path, pivoting to Section 301, because he's only got 150 days. You have to have a formal investigation, which means you got to produce a report, you got to throw a bunch of people at this. And this is very vague. It permits tariffs in response to unfair foreign trade practices. And one thing I liked about the output here with DeepThink is it was clever enough to put these air quotes around unfair, indicating that it was a vague word, that more than likely the Act doesn't have a listing for what the hurdle rate for unfair would be. Just unfair. Well, anything is unfair. If you don't have a definition of the word unfair, you could make any argument to claim that it is unfair. So they're coming back. And he'll probably use this as his cudgel. That these investigations are ongoing. We're finding things that nobody thought was possible. No one's ever seen anything like this. These tariffs are going to be very high. We were bringing in billions and trillions of dollars into our country. We're going to bring in many, many more trillions of dollars into our country now with some of the things we're uncovering. And he'll use that as a cudgel to get people to negotiate, get other countries to negotiate, which is why I asked, what is their willingness at this point? Congressional extension. You can have these extended under 122. Sequential declarations. Legally risky. But that's never stopped this administration. It's just do it, and if we get sued and we can't do it, oh well, we're right back where we started, but at least we started something, right? So after the 150 days, they can declare it again. It says here, 122 has never been used this way. The maneuver would face immediate and severe legal challenges regarding the separation of power. Probably, but that would probably take another 6 months. And during those 6 months, at least you have that going. There is no downside for the administration on this other than going right back to where you started. Nobody's getting charged. Nobody has a fine. Nobody's gone to jail. Nobody incurs legal bills. It's the American taxpayer. So as far as saying you're going to get sued, it's like, so what? If there's no downside to getting sued, if it's just that you have to stop what you're doing, I'm not going to get a fine. I don't have legal bills to pay. I'm not going to jail. I'm not going to be restricted. I'm not under house arrest. What's my downside? Of course I'm going to keep doing it because I'm not paying the bill. The taxpayer is. So if he has nothing by that date, I don't know that I would put this at any kind of low risk. I'd probably say look for him to do that and let the courts figure it out after. Likely path to increase tariffs beyond the 10%, which is what I had said. And the first one was he has the authority to go to 15. And again, I did this Friday night. And of course, Saturday when I got up and I looked at the feeds, there it is, 15%. So Bravo, Deepthink, you got this one right. He moved it to 15% almost immediately, almost as if someone sent him my answer and said, hey, did you know? Did you know? Exceeding 15% using alternative statutes. Well, we've already talked about unfairness, Section 301, unfair trade practices, Section 232, national security. But instead of a universal across-the-board global tariff, the administration would have to tailor the higher tariffs to specific countries under both of those acts to specific countries. So you got 5 months to get this done. You do have to produce a study. You need a team of probably 2, 3, 4 people on every single country. Bigger teams for bigger countries, smaller teams for the island with the penguins. There's that bird again. 1,000 researchers for the next 4 or 5 months to get the studies done. Now, not all the tariffs are gone, by the way. Some of the tariffs remain in place. Automobiles, that tariff remains in place. Furniture, that tariff remains in place. There's semiconductors, pharmaceuticals, and steel and aluminum. Those stay in place. Steel and aluminum is still 50%. You still have, I believe, 10% to 15% on automobiles. So all of that, it stays in place. Now we're at 15% across the board. So I think we're almost pretty much at the same place we were. It's just the tariffs are on different things and at different rates. So it's customs that has to work all weekend to to change their rates and change their systems, and maybe there'll be some holdup at the border while they change that. But I don't think this is going to affect the flow of money coming out of the American consumers' pockets to pay for the tariffs, as the study from the New York Fed demonstrated. By the way, Hassett really attacked those authors. They should be fired and removed from their position. He walked that back on Saturday, saying, oh, I didn't mean to say that. I actually retract that. Because he's doing that, you're attacking both Fed independence, and since one of them was an academic, you're also attacking academic freedom. You're not going to believe it. The bird landed like 5 feet away from me on the counter here, just staring at me, waiting for me to talk. I can see it. There, it just flew away. So some of the tariffs still remain in place. And with this new 15%, I think that probably puts you at either the same or slightly higher tariff rate than you had before. So TLT should, based on this, by Monday recover once the market sort of looks at it and says, well, look, these are here to stay. TLT should recover. All right, let's look at some of the economic data last week. Earlier in the week, ADP, employment change weekly, 10,250, which is about 41,000 run rate per month, up from 7,750 the week before. Canada, inflation rate 2.3, down from 2.4 in December. Core 2.6, down from 2.8. This is interesting. Month over month for January, 0. For December, negative. So you have 2 months in a row where it's either no inflation or deflation. And the core inflation rate, 0.2. The month before was negative 0.4. Japan, 1.5, down from 2.1. First time in 4 years, below the 2%. When I saw that come out, I thought, this is big, and hardly got any mention at all. Core inflation rate 2%, down from 2.4. Inflation rate ex food and energy year over year 2.6 instead of 2.9. Look at that. They fought against that for years. Deflation. And they had inflation. They said, oh, we got to get that down. Well, you're not going to end up where you want. Deflation. Let's see if that continues on. U.S. durable goods, negative 1.4, down from 5.4. This is backwards looking here. We're in February. This is for December. If you take out defense, durable good orders ex defense, negative 2.5. November, 6.6. Look at balance of trade for December, negative 70 billion. The month before was negative 53. Negative 70, going in the wrong direction. Exports not helping out, 292. The month before down to 287. Exports down. Imports 345 up to 357, also not helping out, going in the wrong direction. Just the goods trade balance, negative 98 billion. And that's where the tariffs are, to convince all this money to come pouring into the country and factories to be built and jobs created like no one's ever seen before. And the goods trade balance actually gets worse. Negative 82 was ugly. Negative 98 on the goods trade balance. We also got GDP, 1.42%. If you bring it to the next decimal place, 1.42. And GDP is the combination of the consumer plus investment plus government spending plus your trade balance. C plus I plus G plus X minus M. Every first-year economics student knows that one. Consumer 1.58. Breaking down into goods and services. Goods actually detracted from GDP. Services added. In goods, durables, negative 0.06, non-durables, plus 0.05. I call those zero, basically, all of this. You could say, well, there's nothing in goods. It was all services. The I, 0.66, change in inventories, 0.21, fixed investment, 0.25. That breaks down into residential and non-residential. Residential, no, nothing there. It's all data center stuff. Government, negative 0.9. Now, you do want to see that, but it does bring down GDP. It does lower growth because if the government is spending a dollar, somebody somewhere is receiving that dollar. That's their income. They go out and spend it. So if there is less taxpayer money being spent, that's actually a good thing for the country. However, the other side of it is those people who are receiving that money are no longer receiving it. It brings the economy into a lower level of growth. Negative 0.9, all from the federal. Negative 1.15, state and local. They're still spending. Defense, down 0.42. Non-defense, down 0.7. And again, this is one of those things where you're happy to see it, but you do have to live with a lower level of GDP. Now, for most people out there, it's like, well, so what? The GDP level is lower. It really doesn't affect me. But taxes are a real deal. The level of debt is a real deal. And we're going to take another look at the level of debt and projections for just the interest expense. And we're going to see that a responsible Federal Reserve that says we're independent, but we're all in this together. You have no choice. You have no choice but to start lowering that short rate now. You've got to get interest rates down. Once I show you these charts, it's pretty wild. So when we see government spending less, you should be happy, because this is we have to stop using the word government spending and start using the right word. It's taxpayer spending, right? So when we say the government should pay for my father's long-term care, change it. The taxpayer should pay for my father's long-term care. It sounds different when you use the word taxpayer instead of government spending, right? The taxpayer should pay $1.5 trillion for defense. The taxpayer should pay $1.2 trillion for interest on the taxpayer debt. It sounds different when you say it that way. And I think more people need to say a way to get that sense of responsibility back, that elections should not be popularity contests. They should be job interviews. But democracy has been broken for quite some time. Trade balance added 0.08, not exports. That took away imports added. And there's the breakdown between goods and services. So we've had pretty erratic annualized GDPs last year, Q1, Q2, Q3, Q4. So I said, let's do it year over year. Let's do the whole year. So real GDP grew 2.22% for all of 2025. That is the real growth rate of GDP, which is pretty good. Anything above 2% on a real basis is pretty good, 2.22%. It's not that much more than a forecast from the Fed of 1.8 in the long run, 2.22, but there it is. Nominal was 5.05. So that means the average inflation rate, we take the nominal and we subtract out the real, roughly about 2.8% was the average price level, the average price increase in the price level in 2025 over 2024, 2.83%. Okay, core PCE. And I'm going to take some time this week and present a case, a very strong case for lower rates rather than higher rates. If you think that inflation is sticky and not going away, we have to look at where are we getting these pricing pressures from, and can the interest rate do anything to fix it? So if we find that there's a bunch of categories based on their weightings and based on their elevated price increases that are really contributing to inflation, that if we took those out, or we brought those just down and left all the others in place, you'd be well within your price target or your inflation target. If we have a category, we can reason with it. We could say, well, if we had high interest rates, bring them up to 10%, would it change the price? And in all the cases I have listed here, the answer is no. Higher interest rates will not affect these prices at all. Something else has to be done. And if that's the case, then you have to remove them. If you're making everything else suffer because there's one category or a number of categories that are bringing up the rate, and you're going to keep rates high, and higher rates will not affect those levels, meaning that you have to crush the other already okay categories, then you're doing the wrong thing. And when I saw PCE came out, it was like, oh, that's all bad. None of that's good. Brace yourself, ZQ. But it wasn't that bad. Core PCE month over month, we're looking backwards here for December, 0.4. Month before was 0.2. That is a big jump up. Month over the price index. This is core. This is headline. Month over month, 0.4, up from 0.2. Year over year, creeped up to 2.9 from 2.8, and the core up to 3 from 2.8. None of that was good. But if you look into the categories, interest rates can't fix food or energy right away, which is why it's always stripped out and you look at core, because food and energy are volatile components that are oftentimes immune from the interest rate. Beef, pork, wheat, soybean, chicken, all up. Beef is up 15% year over year. Pork up 22% year over year. Chicken up 28% year over year. This can't be fixed. Beef. We have the U.S. has the smallest herd since the early 50s. Now, you can't just say it's the smallest herd since the 1950s. You can count it. You have to say, but the population in the 1950s was much smaller than it is today. So the herd, as a percentage of the population, or per person or per capita, however you want to calculate, once you control for population, is much smaller than it was in the 1950s, and beef prices are elevated. This is a tricky one. You can say, but why don't we just import beef? We can lower the prices. If you lower the prices, you lower the incentive for the ranchers to increase the size of their herd, because they're not going to get the money for it. Because all of this imported beef is depressing prices. You're not going to increase the herd. You will build a structural reliance on imports. However, it takes several years to fix this. So all the consumers will have to pony up the higher prices such that the cattle farmers find the incentive to build their herds. The sacrifice of the many for the benefit of the few. Sounds like a union, doesn't it? Sounds like socialism, doesn't it? Smallest herd since the 1950s. Energy, AI data center demand, geopolitics. We have the issue with Iran. And I do think you have a looming resource war for the next 4 or 5 years coming. We won't have a conventional war, but we will have World War III, and it will be fought over resources. Electricity is up 7%. The forecast is to be up 6% all the way to 2027. It'll be up 6% over 2020, 2026 over 25, 6% 27 over 26. You can't fix that with higher rates. Higher rates would more than likely slow it down by making investment costly. Higher rates would only result in higher utility rates, because utilities go to a commission and they have a certain amount of debt and a certain amount of equity, and they have this weighted average cost of capital, and the utility commission says you get your weighted average cost of capital net income is that much dollars. And then they work up the income statement to get to revenue, said you need this much revenue to get this. This is how many customers you have. This is how much they have to pay. Look at what's in there, debt. So higher cost of debt, higher weighted average cost of capital, higher net income, higher revenue requirement to get that done. You'll only push electricity rates higher if you keep rates higher for longer, or even, dare I say, go higher. Oil, 15% year to date. From January 1st to now is up 15%. Higher education, higher interest rates aren't going to fix that. 5.6% per year since 1983. AI can fix that. I feel sorry for almost the entire education space with AI. I'm going to show you something a little later on. I use Claude 4.6. And I got to say this now. If 2 months ago you asked me about AGI, a general level of intelligence, I would have said won't exist. It'll still just be code. Oh, it may produce very good output, but it won't be intelligent. I would have put, if you asked me, what is your confidence on that statement, I'd say 100%. I got 100% confidence on that statement. But I've used 4.6 Opus for a while now, since it came out. I would have to lower that confidence. Now, I still don't believe in AGI, but I don't know that I'd put 0 on it. When I read its output, I think, oh my God. You know, it has these nuances and these thoughts that I think, but that wasn't even, my prompt didn't even indicate that. You went there on your own and you brought that in. That's incredible. That I would have to give some weighting to it now. I wouldn't be at 100%. No, it's not going to happen. I might be 95%. But I do have to open up some room that, maybe I'm wrong here. I'd put some probability on it, so we're gonna look at that. And if that is the case, then I feel bad for almost everybody in the education space. They are going to have to change and change fast. Healthcare, 3.69%, highest in 3 years. ACA premiums are expected to double this year in 2026, so that's only going to go higher. Push the interest rate to 20%, you won't change that. You won't change this, you won't change this, you won't change this, you won't change this. Other things, housing. Higher interest rates will only make housing more unaffordable because there'll be less investment in spec homes. Memory and storage. That is our spotlight company this week, Micron. We're going to look at the memory storage and ask ourselves, can Micron hold on to this price, or is this just a one-year thing or a couple of quarters? We're going to look at the shortage in memory and determine how that shortage and when that shortage can be rectified. Insurance, not going to change insurance premiums. Metals, it's not going to change metals. In fact, higher interest rates will just make it worse by making the cost of developing out new mines more expensive. It'll increase the weighted average cost of capital for mining firms, and they'll say, well, we can get the copper out of the ground economically, but not at these rates. If you bring borrowing costs down, well, suddenly some projects that might have been net present value 0 or net present value low might have a nice net present value in the present value of their future cash flows and get a green light, right? So you can't fix any of this stuff with interest rates. Housing makes up in CPI 32%, in PCE 16%. Insurance has a weighting. Higher education has a weighting. Healthcare has a weighting. Take all those and bring them to target. Job done. So what you're doing is you're crushing everything else to try to fix something the interest rate can't fix. And if the interest rate can't fix it, then you ignore it. So argument number 1 for why lowering the interest rate 2%, even a 1%, is not going to affect anything, because none of these things can be affected by that. These things take policy to fix. You need policy to fix healthcare. Technology and maybe some policy will fix higher education. This stuff over here is going to be tough to fix with policy. And maybe AI can do something with insurance. You're not going to fix memory and storage. You're not going to fix housing. You're not going to fix metals and copper with AI. I don't see anything in policy. The interest rate, really, you have to affect the cost of capital, and that's the interest rate. Take a brief look at our economic calendar this week. Not a lot going on. You have Tuesday night, State of the Union, which is not on this calendar, and you have the big guy reporting this week, the whole AI story, NVIDIA, and that is Wednesday after the bell. And Friday, PPI. That's really about it. The backdrop of this for this week, you'll notice, is just a lot of Fed speak. Maybe don't speak so much, right? But just a lot of Fed speak. So ZQ is going to bounce around quite a bit on all of that, I'm sure. So we don't really have much on Monday for the U.S. factory orders. You have Waller speaking at 8 a.m. in the morning. And Tuesday, you have a lot of Fed speak. There's Goolsbee, Bostic, Collins, Waller, Cook, Barkin, and Collins again. We do have some housing price indexes, Case-Shiller out at 9. Going into Wednesday, more Fed speak that you'll see. Not much excitement on Wednesday. This is the day after the clown show we're going to see Tuesday night. And then after 4 o'clock, we get NVIDIA. Thursday, not much. The usual releases happen on Thursday and Friday. Canada growth rate for Q4, and we get December's second look at December and preliminary look at January GDP, and we have PPI for January coming out on Friday. Let's look at our rates and yields story for the week. Rates all up just slightly. Yields right back up again. We're still down for the year, so you can see the yield curve here, February 20th in blue, is slightly lower on the longer end than from January 1st, but not by much. The volatility that we're seeing in the longer end of the curve has really come down from 6 months ago, 8 months ago. Looking where ZQ is pricing in for the year, 55.5 basis points. We have in March, the next FOMC coming up. We get summary of economic projections. I'm wondering if it will incorporate a new Fed chair, and if they'll start thinking differently, or if it'll just be a continuation of the Powell Fed. Going all the way out to May of 2027, 63.5, so about 2.5 cuts in 10. I am still of the belief that this is massively mispriced. If we don't get a rate cut under Powell, you'll get 50 basis points out of the gate under Warsh. A change of strategy and consensus building, I think he can get that done. I think he can make the argument for it. As simple as I can make the argument for it, like, look, what are you hoping to solve with the interest rate going higher? Let's go through the categories one by one, shall we? And you tell me what you think will happen. And if you say, well, no effect enough times, I think job done. The interest rate can't fix that. Now, can I walk you over to the level of debt and ask, do you think we're on a sustainable path? We are the holder of the interest rate. We are responsible for the interest expense. I think I can get consensus. Now, I wouldn't say it that way. I certainly wouldn't say it that way. I'd say it in such a way that you would come to that conclusion on your own. So I think this is the curve we have. Let's just focus on the curve. What is going to happen is this short rate is going to come down all the way out to the 1 year. These are all money market rates. These tend to move in parallel like this. I think these come down. Long end of the curve probably stays the same, so you'll probably have a big move up to the 2 year. Once we're done. Actually, let me rephrase that. The 2 year would probably be somewhere around here, I think. If you got, we'll say 2% here, and the 2 year would be slightly higher. But I think the long end of the curve stays where it is. So between the 10 year and the 3 month, you're going to get, I think, a significant slope. That will convince banks to buy the long end of the curve. Because they can finance a 4.1% 10-year with a 2% overnight rate. That's a 210 basis point net interest margin, 210 basis points. That's pretty good. So I think you can keep the long end of the curve in check by steepening that curve and incentivizing banks to say, hey, 210 basis points, let's lend money to the government. Banks should do well under that environment, and I think the market agrees. They're up 11% year to date. They had a good week last week, along with that nice yield. Dollar index had a good week last week. Pretty solid week. I think that was based on the escalation of the hardware around the country of Iran, the U.S. military hardware. You get a resolution in there, I think all of that comes right back out. It's still weaker for the year, but half a percent isn't too bad. Our big winners for the year to date, still Staples, did not have a good week at all, gave back almost 2% of their gain. Utilities and real estate doing quite well. Small caps still in there. SPY now positive for the year, not QQQ. And that usually turns down if you have big corrections and bear markets. That QQQ turns down before SPY. Oftentimes two quarters before. And 2 quarters puts us pretty much where we are now. End of March would be considered 2 quarters. They hit their high at the end of October. November, December, January, February, March, April. So we say 2 quarters, April, before SPY really starts to fall off. And we're going to look at a chart. We're going to see it's been just trading in a range now for quite some time. And it is feeling rather extended. And AI, I'm telling you, is going to continue to rip through every sector of the economy. Cybersecurity got hit on Friday. And we're going to look at that. I think unfairly got taken down. I had some people here. We're doing seminars this week, and we were doing some scanning, and I looked at my screen. I was looking at one of them. I said, whoa, what happened here? And CrowdStrike was down $30. When I looked at it, what's going on? I looked at all the cybersecurity, and they're all down. Well, what's going on? Cloud Code Security. So I immediately started buying across the board, everywhere, because I know about cybersecurity. I know a thing or two. And when I saw what it was, I thought, okay, that's wrong, and I bought. So we'll spend some time on that. By the end of the year, 2 cuts in 7. Again, I do believe that is wrong. I think at a minimum 3. At a minimum 3, and probably before October. Minimum. I think you can get to 2 to 2.5% by the end of the year. I think you almost have to get to 2 to 2.5% by the end of the year. Real rates, all of them, down from the beginning of the year. Year to date, they did creep up last week. Inflation expectations, throw another basis point on there for good measure. They're up over the course of the year. And given the stress we've seen in private credit, you would think that credit spreads would widen on high yield, and week over week, no, they did not. They contracted on high yield. However, to be fair, these are as of Thursday. We don't have the Friday numbers till Monday, and really the explosion in Blue Owl really, it started midweek. Started Wednesday with the redemption story, and then really started to explode on Friday. CoreWeave was a victim of that. That debt could not be placed very well. So we'll have a look at the fallout from that and what we would expect from that. But no, high yield says no. Now, I did hear, and I have expressed this before, the reason that high yield is behaving this way is all the lower quality stuff that normally would have been issued as high yield debt, publicly traded high yield debt, all that lower quality stuff went over to private credit. So what is left in the high yield public market is the higher quality of that higher yield. Well, that does seem to make a little bit of sense. So it's like, well, okay, year to date, we're slightly up on that. 601 on the 30-year fixed rate mortgage, 601, but I think Friday probably had something to do with making that bounce right back up. The 10-year did add basis points on Friday, so the mortgage would, but 6.01, we're almost printing a 5. National Association of Home Builders disagrees with that excitement, still sitting at a 36, way under 50. Housing starts month over month, November up 3.9, December up 6.2. That's pretty good. Pending home sales, January negative 0.8. So in the housing market, some good news starting to show up there. Let's have a look at our metals for the week. Week over week, all of them did well. Gold, silver, copper, aluminum, platinum, palladium. Year to date, look at some of these numbers. 18% still going. Silver 18.6%, palladium 11.2%. Copper is my favorite play. I have puts on copper on HG. HG is the futures contract. I am now short 10 puts from 585 down to 560. I have 4 different strikes. No problem having those put to me. If I saw copper get down to low 5s, high 4s, I see a 4, I'd probably go to 30, 40, 50 contracts long on copper, and I would just keep rolling those. Oil up 6% for the week, up 15.6% year to date, offsetting it. Natural gas down 5% for the week, down 18% year to date, and food prices not helping out at all. Cattle year to date up 5.6%, added more pricing this week. Hogs up 2%, soy up 10.5%, wheat up 13.4%. This is just year to date. The only relief you're getting is in corn, but your oil and gasoline higher, food prices higher. Higher interest rates will not solve that. That's a big part of affordability. When you hear consumers complaining about affordability, that's a big part of it. A big part of it. Higher interest rates are not going to solve that. You have to look past it, and then you have to look past the categories that interest rates aren't going to fix. Nothing you can do about that. Agency, Annaly, mortgage-backed securities all had a good week. Year to date, they're all positive. All of them outperforming the S&P, by the way. And then once you add that yield in, they are significantly outperforming S&P. Agency being up 7% year to date with that 12.5% yield. Even if it went nowhere from here and you held it for the year, you're 19, 20%. That will, right there, my prediction is that will easily beat SPY this year. We have 24 days to the next FOMC, and we get the summary of economic projections. The odds on zero, or the probability, not the odds, the probability of zero increased to 96.5 to say that it's almost a sure thing, up from 90%, and we are down to 3.5 on a rate cut. Given this Fed, I think that is the right probability. My personal opinion is that it should be 25, just based on what the interest rate cannot do. It should be 25. You're looking at a job market that isn't healthy at all. Once you control, as we did last week, once you take out healthcare, which is a function of demographics, not a function of economic activity, the U.S. has been at or near a recession in the job market for the last 5-6 years. Take out government spending, and the U.S. has been a very sick economy for the last 5-6 years. Yes, I would be cutting 25 basis points. I'd be going all the way to 1% because just the sheer immunity of the American economy from interest rates means high interest rates only cause pain. But I'd be moving it down. And a little bit of it is, well, I would make money if interest rates went down, so come on. Powell's last stand, at least either 0 or 1 cut. 99.5%, all of that is on the zero. He's not going to cut. 82.5, that's 99.5, up from 97.9. You're not getting 2 cuts. I think that's right. You're not getting 2. I seem to think I'm going to hold out hope that the data allows them to cut one more time to give Powell a nice exit to say we are now at neutral, or pretty much at neutral. I think we're slightly above neutral right now, If you can get him out the door at neutral as a parting gift, his legacy is set. And then he's worth millions in the private market on the speaking tour, book tours, corporate board seats. He's worth millions. He's not going to hang out to make a point. He's not going to do that. Warsh's first meeting last week, at least one cut, almost 70%. Note down to 53.5. I can't understand why the market can't simply listen to what this guy has said over his career and just take him at his word. But no. He's going to turn into a Powell. He's going to just move over, and it'll be Powell with a different face and a different name. That's not going to be the case. This is the most egregious mispricing I've seen. Warsh's first meeting. If you do truly get zero over here, we're over here, and the market has it at 7.7%. I would say at least one cut, 100%. At least one. There should be zero on this one here, 0%. Well, why not keep it 2% just to say, well, I did say 2% in case you do get zero. You're not wrong. No, I did say 2%. I did say it was possible. I'm going to go ahead and say 0. 100% you're going to get at least one, if not more cuts. But here we are. The reverse repo is disappearing. The lowest was 377 million. We're at 496 million. We've lost the B. Not even when you're worth using the billion now. May as well just call it in millions. Repos are at zero. Reserves just under 3 trillion. TGA just under 900 billion. SOFR 3.67. But what a ride it had. On the 9th, 3.63. Jumps to 3.65, the 13th, 6.6, the 17th, 3.71, the 18th, 3.73. You saw that in SOFR. If you were using SOFR to bet on the short rate instead of ZQ, you had a lot of pain this week. 3.63 all the way to 3.73. You're down 10 basis points, and nothing has changed. You did get some relief on the 19th, 3.67, but we got to watch this kind of thing. That's not good to see. I left this out on the outside. New home sales month over month. November up 15.5%. December down 1.7%. Okay, we're going to look at U.S. debt in 6 charts. And I think when we're done, you're going to see that this is a bigger problem than people are admitting. When we look at down here, we look at 52 companies that are hitting 52-week lows. We're looking for these turnaround stories. You got to be a wickedly good stock picker if you're looking at the 52-week low list. That's where I found AT&T, $16, $15 with a nice yield, and they almost within a year, almost 100% increase. Went on to 52-week highs at $29. All within a 1-year period. But you got to look really hard, and you've got to be good. But above all, you're looking for one thing more than anything else. If a company's hitting 52-week lows, even 2-year lows, 3-year lows, it means they have a problem. It means there is something wrong. And those are usually the targets for activist investors. The one thing you're looking for is this. Does management recognize it has a problem? If it does, that's the beginning of a turnaround. They must recognize that they have a problem. If you find a company that has value and deep value hitting 52-week lows and management doesn't recognize it has a problem, you either have to have a lot of money and move in as an activist investor or just stay away. Well, this is the administration. We have a debt problem and an interest rate problem. There is a big problem, and it's unsustainable. If the U.S. were a publicly traded corporation, it would be hitting 52-week lows. Does management recognize it has a problem? No, it doesn't. If you listen to both sides, not one now, both sides whenever they're in power, neither one of them talk about, we need to solve this problem. We got to get this down. We got to cut expenses here and here and here and here and really do it and get it down. No one's talking about it because, as Mitch McConnell says, no one ever lost an election because they spent too much money. So every election, you get money and we'll spend this and we'll spend that, and no one even cares about the public debt the taxpayer debt, not the government debt, the taxpayer debt. So we're going to look at taxpayer debt in a number of charts here. By the way, I do have each of your bill right down here, just for the federal debt. You all owe $113,354. If you're a family of four, $453,000, please. That is your share of the debt. That's not government debt. It's taxpayer debt. That is your share, your household share of the debt. Which means the assets you have are fair game for this government at some point. They gotta get it from someone somewhere. Look at the first chart. Cumulative interest costs. This is year over year, 2020, 21, 22, 23, 24, 25. The U.S. has an October 1st to September 30th fiscal year. So here it is here. Here's 2026, already higher than 2025. The change in debt, just the change in the level of debt from February 4th, 2024 to 2025 was 2.35 trillion. So on February 4th of this year, the debt was 2.35 trillion, higher than last year, with 1 trillion of that coming just from the interest on the debt being added to the debt, plus whatever deficit spending there was. Average interest rate 3.348%. To put this in perspective, the debt in the U.S. is increasing at a rate of $6.43 billion per day. Per day. Ouch. Net interest, third largest spending category through January for the federal government. This is just through January. This is October 1st through January 31st because, again, year to date, fiscal year to date, Social Security, Medicare, and then you have net interest. There's national defense, Medicaid, income security, veterans benefits. This is really where you're going to have to do something. You're going to have to do something here because it is unaffordable and unsustainable. And now the something could simply be, you know what, tax rates have to go up. And one thing about the tariffs is it is a tax, except it's not a tax rate. It's not thing that the consumer can see, and you can always tell them, as per 1984 in Newspeak, that other people are paying for it. We're charging the other countries. You can just lie. But in the end, it is a tax on the American consumer. Interest expense will be 3.2% of GDP in 2026. 3.2% of GDP is your interest expense. This is cumulative fiscal year 2026 interest payments so far, $346 billion. This time last year was 322. So you can see that the interest expense is just going up, and the interest isn't being paid. It's just more debt is being issued to pay the interest. So now the debt is increasing at the level of fiscal deficit and at the level of the interest on the debt. And next year, you're going to pay interest on the debt and interest on the interest on the debt. It's going to get unsustainable fast. Well, it already is on an unsustainable path, but there is going to be a point at which you cross a line where you have no choice but to cut big time or raise taxes, because this is taxpayer debt. They have to pay it. And if you all paid it now, it's not much. Come on. $113,000 per person. Come on. Net interest costs are projected to rise sharply. This is where you are now. And by 2036, 4.6% of GDP. 10-year interest costs, $16.2 trillion, along with all the deficits along the way. All the deficits along the way, they keep adding up, along with just the interest expense. Now, this is assuming that you take the debt and you put the interest on top of the debt, and then you calculate your interest next year, and you put that interest on top of the debt, and you calculate it next year. Just accumulation of all the interest. You got to have some projection as well for how much is the deficit going to continue increasing each year. So if you're going to have another $1 trillion deficit spending on top of the 1.2, 1.3, 1.4 trillion in interest expense, you can add another 10, 12 trillion dollars on top of the 16 trillion, 28 trillion on top of the 38 trillion, which will be 39 trillion by the time sometime in April will be 39 trillion. You'll be somewhere around $67 trillion in debt. You have no choice but to flatten that interest curve all the way to zero like Japan did. Cannot afford that. Average interest rate by security type. This is from the Treasury, 3.348%. This is capital markets. This is money market. This is market determined. All right, this will be Fed determined. Wherever you place the Fed funds rate, the short end of the curve, if you think about money market and capital market, up to the 1 year, if you set the rate down here, the money market funds will follow that. Capital market will be its own thing. It depends on what goes on in the capital market and the supply and demand for bonds there. So you can take this and you can drop it down to here, or even at 2% if you drop it to here. That is something that the Fed can do quite easily. And the Treasury can then start favoring Treasury issuance, and you can start to bring this down. Wouldn't have much of an effect initially, but if you continually roll over your debt using T-bills, you can get an effect. If you starve the long end of the curve, the market will slowly start to price these down as well, and you can lower the whole curve. And if we're looking at which one you'd want to issue on, even though this is the more expensive one right now, this rolls over every 30 days, 60 days, 90 days, 120 days. Here is the trajectory of that cost of debt right now. It's going down, whereas all the others are moving up or even sideways. Total marketable is sort of creeping up a little by little. But your T-bills is sort of where you'd want to issue, because now you have floating rate debt. And if you have a Treasury and a Fed that says, look, we both got to solve this problem, you can start to take the U.S. off of this unsustainable path. Okay, let's have a look at my use of Opus 4.6. This is so good. We had a sell-off in cybersecurity stocks on Friday because of Claude Code Security. And the moment I saw it, and it was pretty deep, I started buying. I bought a bunch of names: Akamai, Zscaler, Snowflake, CrowdStrike, Palo Alto, Fortinet, a few others. I bought shares and sold puts. And it still kept going. So we're going into 345. I just said, okay, here's 8 names. Give me 100 shares across the board. A little while later, give me another 100 across the board. Then I went surgically on a few others. I think I probably added incrementally, just in that last hour of the day, probably 600,000 of exposure to the cybersecurity sector in a bunch of different names. Because I felt immediately this is overdone. So I thought, maybe I'm missing something. I better check in with Claude and see what it says. So I asked it. Friday, February 20th, 2026, Claude introduced Claude Code Security as a limited research preview. Are you familiar with the new release? I first want to make sure that it knows what it is. And I want to know what it knows so I can say, yep. You baseline it first. Whenever you're using AI, don't ask your next follow-on question right away. Baseline what it knows first so that you can correct any misunderstanding there, because everything after would be garbage. You want to know that it has a good, firm foundation, and then you ask it questions on that. Yes, I'm now up to speed on it. Announced yesterday, limited research preview. Here's a summary of what it is and why it's getting so much attention. What it does, it scans code bases for security vulnerabilities and suggests targeted software patches for human review, allowing teams to find and fix security issues that traditional methods often miss. How it differs from traditional tools. Rather than relying on rules-based static analysis that matches code against known vulnerability patterns, Claude Code Security reads and reasons about code the way a human security researcher would, understanding how components interact, tracing how data moves through the application, and catching complex vulnerabilities like business logic flaws, broken access control, and authentication bypass. Key details built into Claude Code on the web, available as a limited research preview to enterprise and team customers. expedited access for maintenance of open source repositories. Powered by Claude Opus 4.6, Anthropic's Frontier Red Team used Opus 4.6 to find, this is wild, over 500 vulnerabilities in production open source code bases, bugs that had gone undetected for decades, despite years of expert review. That's a bold claim. Every finding goes through a multi-layer verification process with severity and confidence ratings, and nothing is applied without human approval. Claude Code Security identifies problems, suggests solutions, but developers always make the final call. Market impact. I did not ask it for this. Notice this. I did not ask it for this, and it told me about cybersecurity. This is where I say, well, that's pretty clever. I didn't ask for that, but you tied it to that. And I wonder if it's because it knows across all my chats that I tend to ask a lot of questions about financial markets. So it just said, listen, I know you so much, you're probably interested in this. Wow, that's pretty cool. You give me a robot at home that runs on Claude, I'd buy it. I'd spend 30 grand. I'd spend 50 grand on that. I would. Walking around that just gets to know my life, reminding, hey, you got a haircut today at 2:30. Ah, damn it, that's right. Let's go, get in the car. Announcement sends cybersecurity software stocks tumbling. CrowdStrike 8%, Cloudflare 8.1%, the global X cybersecurity ETF 4.9% down. Some analysts call the sell-off an overreaction, arguing the tool doesn't directly compete with established cybersecurity businesses. Something you'd like to dig into. Now, this next part gets super interesting because I looked at the output and I thought, wait a minute here. So what I had in Interactive Brokers, there were a few stories, and there was one analyst. So I opened it up and I read the review from this analyst saying, well, the names we cover, these names here, we know these names, and this code security has nothing to do with what these companies do. Unfairly punished. And then I went to Claude and I said, okay, well, let's ask some more questions here. Now, I read something somewhere, and then I asked this question. I'm going to point out the part of the answer that was a little bit creepy. Anything specific you'd like to dig into? My prompt, yes. You ended with some data on the reaction in cybersecurity stocks. I am on the side of agreeing with analysts that this product is not a competitor to cybersecurity firms. It appears more like a developer security tool. Code vulnerability is, of course, one vector of attack, but even assuming error-free and hack-proof code, this would not reduce the need for cybersecurity. Now, it may sound like I'm leading it. I'm telling it what I believe. And this is what you always want to do. I already believe that. You don't need to convince me of it. I already believe it. Prove me wrong. Give me the best case that the sell-off in cybersecurity names is warranted, but purely on the release of Claude Code Security. It could be warranted for other reasons. That's fine. But it's sold off on this. Give me the reasons why it's warranted purely for this. Once done, give me your assessment of the strength of that argument in percent as a basis for investors to sell or pare down their holdings. So if you give me the bear case and you say I'm 90% certain on this, then I got some thinking to do. Let's see what it did. And as you're reading the bear case, as I was reading, I'm thinking, yeah. And it made a good case because you have to make the strongest case possible. And if you can beat the strongest case, then it doesn't exist. Steel manning the bear case before stress testing. Let me lay it out. The core argument rests on the idea that Claude Code represents a paradigm shift in how vulnerability management gets done. First, a meaningful share of cybersecurity spending today exists because code ships with vulnerabilities. Not what I wanted to hear right out of the gate. Endpoint detection, web application firewalls, intrusion detection systems, SIEM platforms, that's identity management. Much of their value proposition is catching and containing exploits that exist because of flawed code. If an AI tool can find and patch vulnerabilities at the source before code ships to production, the attack surface shrinks materially over time. Fewer exploitable bugs in production means fewer incidents, which means less urgency to spend on detection and response tooling. The long-term demand curve for downstream security product bends downwards. I read that and it's like, oh, okay, well, yeah, that's a good point. Next one. Second, this isn't just another static analysis tool competing with Sync or Veracode. So there's static and dynamic analysis when you're looking at vulnerability. Static analysis is just tracing through the code. You look at it and you trace through the code. Dynamic is you run the code and then you test it while it's running. It isn't just another static analysis tool. The fact that Opus 4.6 reportedly found over 500 previously undetected vulnerabilities in mature, heavily reviewed open source code bases suggests a qualitative leap. If frontier AI models can reason about code at a level that surpasses years of expert human review, then the entire category of application security testing tools, a multi-billion-dollar market, faces potential commoditization. Why pay for expensive SAST, DAST licenses when the general-purpose AI model outperforms them? S is static, and it's just application testing. The D is for dynamic. So 2, it's like, okay, I'm starting to get depressed as I'm reading it. 3, there's a platform displacement risk. Anthropic is embedding this directly into Claude Code, which developers already use for writing code. If security scanning becomes a native feature of the AI coding assistant, essentially free at the margin for enterprise and team subscribers. A little bit of marketing in there, Claude. Essentially free if you have enterprise and teams. May I upgrade you now? But wait, that's not all. We'll throw in a set of steak knives. It collapses what was previously a separate budget line item into the development platform itself. That's the classic bundling threat that has historically crushed point solution vendors. It's like, okay, I've had enough. Claude says no. 4th, the open source angle is strategically significant. Offering free expedited access to open source maintainers, Anthropic is positioning itself to raise the security baseline of the foundational software that most enterprise applications depend on. If the libraries and frameworks underpinning commercial software become meaningfully more secure, the risk profile changes for everyone downstream, again reducing the perceived need for layered security spending. At this point, how many of you are saying, holy shit, I need to reassess. I better sell calls. Let's see if I can get out. Let's keep going. Finally. Okay, thank you for the finally. There's a signaling argument. Anthropic is one of the leading frontier AI labs. Okay, Claude. Okay. A little bit of patting yourself on the back. And this is their first major move into security tooling. The market may be pricing in not just what Cloud Code Security does today as a research preview, but where it's headed. Autonomous security agents that continually scan, patch, and harden code bases. If that trajectory plays out, the implications for incumbent vendors are substantial. And if I end here, what would you do? And so that little trick in the prompt. Give me your confidence level in this. I asked it purposely to give me the strongest bear case. And this is a pretty strong bear case, but does it believe it? There's a difference between make the argument and do you believe the argument. If you ask me to make the argument for the existence of God, I will. I'll use the language to make the argument for it. And then if you ask me, do you believe it? My answer would be, no, I don't. But you didn't ask me to write what I believed. You asked me to make the argument. So you always say, what is your confidence in this statement? Here's what we get. My assessment. I'd rate the strength of this argument as a basis for selling or pairing cybersecurity stocks holding at roughly 10 to 15%. I thought it would have been higher. If it said 70 to 80%, I probably would have really been thinking, man, I got some blind spots. Let me just play it safe and sell some calls. Here's why the case, while intellectually coherent, is far too forward-looking to justify the magnitude of Friday's move. The argument fundamentally confuses code-level vulnerability with cybersecurity writ large. Even perfectly written code doesn't protect against phishing, social engineering, credential theft, insider threats, misconfigurations, supply chain compromises, ransomware delivered through non-code vectors, or zero-day exploits in hardware and firmware. The vast majority of breaches involve human and operational failures, not novel code vulnerabilities. Code scanning, however good, addresses one layer of a deeply layered problem. Moreover, Claude Security is a research preview. It has no production track record, no proven false positive rate at scale, no enterprise deployment history. The jump from impressive research demo to structural threat to CrowdStrike's endpoint business is enormous and not supported by what was actually released. The bundling threat is real in theory, but slow in practice. Enterprise security procurement is driven by compliance requirements, audit frameworks, and CISO mandates, not by what's convenient for developers. These buying cycles are sticky and institutional, and critically, the tool is positioned as complementary to existing security infrastructure, not as a replacement. Anthropic framed itself as a force multiplier for defenders. Barclays analysts were right to call the sell-off an overreaction based on what was actually announced. I stopped right there. I said, what? I never said anything about Barclays analysts, but I did read on Interactive Brokers in the newsfeed, open a story from a Barclays analyst. And I got to this, I go, wait a minute, why choose that one? That's creepy. Is it watching everything I'm doing on my computer? Because I tell you, I've had this problem before with the iPhone. Is I'll be talking about something, my microphone won't even be on, I'll just be holding my phone and talking about something, and then I see ads about something like that, or I'll get an email about something. I was in one mall in Square One, and I walked past one store. I forget the name of it now. I had bought towels there before, and I was walking past it. And I was with someone and said, do you want to go in and see if they have anything else? I said, I don't really need to go in. I kept on walking. About 4 or 5 minutes later, I got an email from that very same store. Maybe that's a coincidence because I had bought there before, and maybe it was a coincidence, but I just so happened to be there 4 or 5 minutes ago. And I was on my way to the airport that day as well. Well, who'd I get an email from? Air Transat. Now, I had flown with Air Transat before, so maybe that's a coincidence. But 2 coincidences in one day where I'm actually talking about this stuff and it just shows up. And here I am, I'm reading a research report from a Barclays analyst saying the names we cover, this has nothing to do. I say, okay. I'd say nothing in my prompt about it, and suddenly Barclays analysts were right, out of nowhere. Creepy, 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 but wow, is this thing smart. In short, the long-term strategic question is legitimate, worth monitoring, but as the basis for immediate sell decision on Friday's news alone is weak. Market priced in a future that is speculative and years away if it arrives at all. It says here, I should note I'm not a financial advisor, blah, 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 but purely on the merits of the Claude Code security release as a catalyst, the sell-off looks overdone. And then I breathed easy. But man, did it make a good bear case. As I was reading it, my heart started dropping little by little, going, oh, these are all good points. These are good points. I can't argue with it. And then that confidence of 10 to 15% is like, great. There we go. Okay, let's use 4.6 again, and let's visit the private credit crisis that has been brought to light with Blue Owl. I should note I am long Oracle and I am short CoreWeave. Short CoreWeave mostly for the volatility, but I play it on the short side, and it really dropped on Friday. Whenever you're short, you do have to pay attention, just so that you put this on your list of things to watch. You do have to pay attention to the borrow rate. This is CoreWeave's borrow rate. It's very short. Very small, I should say, 30 basis points. IB allows me, and I don't know if this is true for everyone, I guess it depends on your account size, but when I short stocks, I get cash in my account. I can earn the cash rate on that cash. I can't invest it in other equities, but I can buy T-bills with that. As long as it's a very liquid money market security, I can earn the cash rate. So you want to make sure your borrow rate is below your cash rate, 0.3. But look what happened on Friday. It just started shooting up. This is why it's important to pay attention to the rates. This is on their Interactive Brokers, Analytical Tools, SLB rates. Everything you're short every morning, call this up. Because if you get a spike, sometimes these borrowing costs can go to 10%, 15, 20%. Then holding that short position becomes extremely costly. You need big moves down when that happens. And if you're playing it for the volatility, the further down it goes, the less time value is left. It's not worth keeping it open any longer. And I just rolled over all of my February puts over to March puts. I think I picked up on average about $9 on each option. 1,500 shares short. Oracle, I'm about 1,000 shares long. And they are both suffering from the same thing. So this is more of a pairs trade at this point. That what I'm gaining on CoreWeave, I'm losing on Oracle. But let's have a look at what 4.6 tells us. Are you familiar with the credit issues around Blue Owl? I spelt it wrong, but it didn't matter. And the problems investors in the private credit fund are having. Use up-to-date information. Today is February 21st, 2026. Yes, it has been one of the biggest financial stories of the week. Here's what's happening. The core event. On Wednesday, Blue Owl said investors in Blue Owl Capital Core 2 will no longer be able to redeem shares on a quarterly basis. Instead, the fund will return capital through periodic distributions funded by loan repayments, asset sales, or other transactions. Alongside this, the firm sold about $1.4 billion in direct lending investments across 3 funds to provide investors with promised liquidity. Biggest chunk came from the OBDC2 itself. Offloaded $600 million in loans, amounting to about 34% of its $1.7 billion portfolio. The other 2 BDCs, OBDC and OTIC, each sold $400 million. How we got here? Didn't come out of nowhere. Blue Owl has been under pressure from redemption requests as its BDC since 2025. Last November, Blue Owl tried to merge OBDC2 into a larger publicly traded fund, but the core problem was structural. When the acquiring public BDC valued OBDC2 at net asset value, investors found themselves receiving shares worth less at the market price than what they saw on their statements. Deal was abandoned. Market reaction: Blue Owl shares fell about 10% on Thursday, lowest level in 2.5 years. Contagion spread quickly. Shares of rival alternative asset managers, including Ares, Apollo, Blackstone, KKR, and TPG, also fell. Structural tension exposed a fundamental issue in the democratization of private credit. Fundamental problem private markets deals have is multi-year commitments that don't line up with quarterly redemptions. When times are good, cash flows cover normal redemption requests. When times are bad, requests surge and it becomes a race to the bottom. Well, that makes sense, right? You're giving me money. I offer quarterly exits, but most of this money is not going to be seen for several years. And if things are good, you're going to hang out there. And the cash flows come in and we can meet whatever quarterly redemption. And things are bad. Everybody wants their money. It's like, guys, listen. Your money's not in the bank. It's over there in Ernie's house and over there in Bill's house. To quote a line from a classic movie. See if anybody can figure that one out. Broader context is concerning. Years of ultra-low interest rates and thin yield spreads encourage lenders to make riskier moves, financing smaller, more leveraged companies at yields that appeared attractive compared with public markets. Dan Rasmussen of Verided Capital called it a canary in the coal mine, warning that the private markets bubble is finally starting to burst. Will it be contained? Retail investors have been playing an increasingly large role in supplying equity capital to publicly traded BDCs, drawn in by dividend yields as high as 16%. And those investors are now finding themselves unable to exit. The counter-argument: not everyone sees this as a systemic crisis. Cliffwater LLC, an advisory firm specializing in alternatives, published a research note arguing that OBDC2's difficulties stem from an obsolete fund structure, not from any deterioration in the underlying loan portfolio or private credit broadly. They point out that OBDC2 delivered an annualized return of 9.11% from inception through September 2025, right in line with broader direct lending index. You could have gone back to 2007 and said, hey, let's keep in mind that mortgage-backed securities have delivered this much return from the beginning to now. It doesn't matter what it did yesterday, it matters what it's going to do tomorrow. 1.4 billion loan sale at 99.7 cents on the dollar, purchased by CalPERS, 2 Canadian pension funds and insurer Kuvari, suggests the underlying assets are sound. Blue Owl co-founder Craig Packer. Whenever I hear the name Packer, I have to laugh. I keep thinking of Packer from the series The Office, and what a boob he is. Here's somebody's name's Packer. It's like I keep thinking of that boob. Anyways, Craig Packer pushed back hard. That's what she said. arguing the firm is actually accelerating liquidity, not halting it. He noted investors would get about 30% of their money back by March 31st, far more than the 5% allowed on the previous quarterly schedule. Okay. So maybe it's not bad loans. Maybe it's just the structure of the fund itself that creates these problems. That's the counter argument here. Whether this is a contained structural issue at one fund or the beginning of something broader in the roughly $1.8 trillion private credit market bracket, add that to the roughly $1.3 billion valuation of Bitcoin that has not been doing well, close bracket, is the question everyone is debating right now. And back in 2007, that was the question about the subprime mortgage crisis. Is it contained? The head of the Fed, the world's premier researcher on the causes of the Great Depression, said, oh, it looks like it's contained. One of the biggest misstatements of all time, or one of the biggest, I think he really believed it. Let's not call it a misstatement. One of the biggest wrong statements, I think, of all time for somebody who should have at least opened up some possibility. Oh, it's contained. The fact that sophisticated institutional buyers are willing to buy the loans near par suggests the credit quality itself isn't the problem. The liquidity mismatch is. But as we've seen in past financial episodes, liquidity problems have a way of becoming solvency problems if panic spreads. Would you like to dig deeper? So I said, yeah, Blue Owl holds debt of some publicly traded companies, and some others rely on private credit markets. CoreWeave and Oracle pulled back significantly beginning Friday morning. What information do you have on this? Blue Owl connection to both CoreWeave and, indirectly, Oracle, significant thread underlying the week's market action. Here's what happened. CoreWeave, the direct link. CoreWeave closed 89.25, down 8.12%. Just last week, it was trying to break 100. And man, from the opening on Friday, CoreWeave was just down. Shares fell after Blue Owl Capital's failed $4 billion data center debt placement raised new concerns about project financing. Trading volume was roughly 65% above its 3-month average, signaling real conviction behind the selling. CoreWeave has terrible debt structure, and in the end, it really just rents assets. It is a REIT without the benefit of the tax structure of a REIT and without the discipline of the debt. Its capital structure doesn't have the discipline a REIT would, but trading at a tech multiple. So this is going, in my opinion, much lower than $89. The specific catalyst, Blue Owl was unable to convince lenders to fund a data center project in Lancaster, Pennsylvania, largely due to CoreWeave's debt rating. CoreWeave, despite its rapid expansion and NVIDIA backing, carries a B+ junk rating from S&P Global. One senior executive at a large specialty lender told Business Insider bluntly, "We saw it, we passed." Blue Owl has only committed to provide $500 million in bridge financing for the project through March. And now there's a real question about what happens when that bridge expires. Blue Owl may be forced to seek credit support from NVIDIA or pool together a loan from its own private credit clients to keep the project alive. Blue Owl tried to contain the damage, insisting the project is on track and noting that its exposure to CoreWeave represents just 1% of its real assets under management. But the timing couldn't be worse. Coming on the heels of the OBDC2 redemption crisis, it reinforced the narrative of a lender under stress. CoreWeave's own debt profile is alarming. Including lease obligations, CoreWeave carries about $15 billion of debt, nearly 4 times its total revenue over the last 12 months. The company paid $300 million last quarter just to cover interest, which is now more than 1/5 of its total revenue and roughly 6 times its gross profit. Its 2031 bonds are yielding around 11.5%. Can anybody say dead company walking? Oracle. dropped 5.4, driven by a related but distinct set of credit anxieties. Oracle's share price has tanked 34% over the last 3 months. Credit default swaps have soared as capital markets are growing worried about its ability to finance the capital investments necessary to fulfill its $300 billion deal with OpenAI. Proximate catalyst Friday, disappointing news on the NVIDIA OpenAI front. NVIDIA is close to committing $30 billion to OpenAI's latest funding round, but that figure is nowhere near the $100 billion NVIDIA was previously believed to be ready to commit. Since Oracle stock and debt are essentially being traded as a proxy for OpenAI's viability, the shortfall mattered. Oracle's own leverage situation is becoming precarious. $250 billion long-term leasing commitments tied to data centers with lifespans of 15 to 20 years, many of which it expects to sublease on shorter time horizons. Company announced plans to raise $45 to $50 billion in debt and equity this year, but the market hasn't been reassured. Bondholders filed a class action suit in Manhattan, claiming Oracle misled investors who bought $18 billion of debt it issued in September 2025, alleging the company knew it would need far more borrowing than it disclosed. Wall Street analysts are now speculating Oracle may look to sell its healthcare software business to improve its financial position. Last paragraph here, or last section, connecting thread. What ties all of this together is broader tightening of credit conditions for AI infrastructure. Something you don't want to hear right now. Major banks have recently had recent difficulty selling off pieces of $38 billion of debt to finance the construction of 2 data center campuses anchored by Oracle, driven by the same lender wariness that killed the Blue Owl CoreWeave deal. Pattern is, the AI build-out requires trillions in financing. Much of that has flowed through private credit and leveraged bond debt markets. Those markets are now balking at the credit quality of key borrowers. CoreWeave at B+, Oracle seeing CDS blow out, which raises existential questions about whether the infrastructure can actually get built at the pace the market has priced in. That's a bigger deal. As one analyst put it, investors are trading CoreWeave less on revenue math and more on whether it can keep building fast enough and financing it without tripping over the credit market. The same is increasingly true of Oracle. Blue Owl sits right at the nexus of all this, simultaneously dealing with redemption pressures in its BDC funds, trying to finance AI data centers for junk-rated tenants, and watching its own stock hit multi-year lows. Whether this remains a contained liquidity mismatch story or becomes a broader credit event in the AI infrastructure is a key question heading into next week. Private credit stress, AI infrastructure financing, junk-rated borrowers all feeding on each other is worth watching closely. Would you like to explore any of these? No, I have enough information on this. I am short CoreWeave. On any rebound, I'm going to short it even more, but I'm going to do it with a synthetic short, which means I'm going to sell a call and buy a put, and probably when I sell the call, it will be an in-the-money call for 6 months. I'll probably be looking to sell the $65 or $70 call and buy the same put, and I'll use a synthetic while the borrow rate is low. So if the borrow rate spikes, it cannot hurt me at all. And I will continue to play that with Oracle. After reading this, I'm thinking, well, you know what? Let's sell some calls on Monday. It can't hurt. Let's lower the delta exposure on this. Let's sell some calls. Not on the whole position, but we'll sell some calls. Cybersecurity, not doing anything. The beauty of being able to ask something like Opus 4.6 these questions and get really good intelligent answers, and I can recognize these as good intelligent answers. That removes a lot of the, well, what if it's this, what if it's that? It gives you this person to talk to that you say, look, push back on everything I say. If you're not using 4.6 to act as your steel man for every argument you believe in, tell it to rip you apart. If you're not doing that, you're missing out. Okay, let's look at S&P. A little bit more expensive this week than last week. Forward multiple 22.01, up from 21.79. There is our forward 4-quarter operating earnings, closing SPX. All-time high still in place at 697.16 as of January 27th. We're down 1.1%, but we have been in a sideways channel on S&P since, well, I guess if we take, where did we can extend it out to about here. Looks like since the last week of December to now, we've been in this sideways channel, and you have AI disruption every single week. Something is getting hit. IWM January 22nd hit its all-time high, sitting at 264, down 2% from there. IJR February 11th squeaking out a new high, 132, sitting just below it, 0.35. And QQQ still October 29th, 634. We're down 4.08% below that. So if you think November, December, January, February, March, April is 6 months, and if the turnover in QQQ precedes the turnover in SPY by 6 months, sometime in April, right? LSEG, we got 55 companies reporting this week. I think only one really matters, which is Wednesday after the bell, is NVIDIA. If we are going to save triple Q, NVIDIA is going to be the one to do it. If NVIDIA can't do the heavy lifting here, then this is going to be under pressure for a while, because AI tends to attack the stocks and companies that are listed within QQQ more than SPY. If I had to find some safe place to hide over the next 4 or 5 years, one place and one place only where AI is not going to hurt me at all, it's going to be metals. We have a structural deficit of ore of all types in the world, an underinvestment in mining for such a very long time. There is no choice but for prices to go higher if you want to get more supply out of the ground, because that supply is in something called resources, not reserves. So we have reserves, which are geologically viable and economically viable, and you have resources which are geologically viable but not economically viable unless the price goes up. You're running out of reserves, but there are resources. The price has to go up. It has to go up. And just with the change in product that is coming over the next little while, the shift to AI computers, and if you do believe in a robotic future, all of that, anything physical, at the heart of it requires energy to convert metals into product. So energy and metals, I would be hiding in metals. AI can't touch me there. Let's have a look at who's reporting this week. But again, I don't think anything else matters. Okay, this is just S&P components, right? There are more companies reporting, and some interesting companies as well, but this is just the S&P components. Domino's Pizza, I wonder if it is doing better than Pizza Hut. Diamondback Energy and ONEOK, this is a pipeline company. Diamondback Energy has been strong for quite some time. Very high volatility on this one. Fun to play. Also on Monday, Ondas is reporting. It's not an S&P 500 component. It was a spotlight company 3-4 weeks ago. Drone company. They're reporting on Monday. I have shares of that, so I'm in it. American Tower, I've got shares of that. It has had a good few weeks, down to 170, then it ran to over 190. We're sitting between the 180 and 190 level. We have earnings this week on that one. Constellation Energy is in there. Home Depot, Keurig Dr. Pepper has not been doing well for a while. Axon Enterprises, think tasers for police force. First Solar, I have shares of First. Actually, sorry, I don't have shares of First Solar. I have 240 puts. And Solar had a great day on Friday with the removal of the tariffs. So I expect on Monday, solar companies will probably give some of that back. But on the other side, rare earth companies may get back some of what they gave up. Okay. Oh, Workday. Now, I'm not interested in this one at all, but I am interested in the conference call. What are they going to say about AI? What are they going to say about the AI apps and the challenge to their very existence? I want to hear what they say. Now, if they say nothing, that's a bad thing, because you always listen for the silence. And when you have nothing good to say, you say nothing, right? So it's always best when there's bad news to address it. Just go after it right away, because silence is even worse. At least address it. I'm going to listen to their conference call. I just want to hear what they say, and I want to hear the analyst questions. I think this one will be entertaining. There's our NVIDIA after the bell, 4 p.m. Salesforce after the bell. This is like just a party for someone like me. Where do you go? What bar do you go to? Do you go to Workaday's party, after hours party? Do you go to Salesforce's after hour party? Do you go to NVIDIA's? I don't know. This is going to be a tough one. Lowe's. We'll see what they can do in relation to Home Depot, and you have TJX in there. Synopsys. Anything else interesting? Trade Desk, they have not been doing well. Last earnings saw them hit the low 40s. They were a spotlight company, and my conclusion was stay away from these guys. I just don't see their market getting bigger. Their market's just getting smaller and smaller. So I would stay away. And yes, they're in the 20s. They're not doing well at all. Wonder if they can turn it around. I still wouldn't play. Them. Going into Thursday, who do we have? Nothing much in the morning that I play. Vistra has been on fire. Look at what they're expected. Now be careful with this, right? Year ago, 94 cents. The expectation is 247, 163% increase. Right? So and Vistra's priced for that. They miss. They could go down even if they pull out 130%. On the EPS. Even if they pull that out, that's still going to be lower than what the expectation is, which is 163% growth. So while it's had a good year, and while it's been doing well, I'd be careful there. Warner Brothers Discovery. Expected to post a loss here, and the fight that's going on over this thing, I hope Netflix doesn't get it, actually. But because I'm long Netflix, I hope that it doesn't get it, but we'll see. Autodesk, you got Intuit. That'll be interesting to listen to. Monster Beverage, 52-week highs on this guy. Block is in there. Dell is in there. That'll be interesting to listen to in terms of how they're dealing with the DRAM shortage and the flash, the NAND shortage. Because we're going to spend some time on that today. That's a big deal. Lots of ones to listen to this week. Thank God I have AI that I can say, tell me what I should know. Give me the 10 big themes I need to walk away with, and then I could ask it specific questions. What did it say about its existence due to AI? And you can go through what used to be maybe 4 or 5 companies a week that you really took a good look at. You can now do 20, 25 companies a week in a fairly good analysis. Okay, our spotlight company this week is Micron. It was a toss-up between doing Micron and SanDisk, but we'll be able to understand SanDisk more and its viability if we start with the memory makers, because they also make NAND as well. Look at the chart here. This is a 1-year chart on Micron. Last April, hit a low of $63 and hit a high within the year, basically early February, of $451. That was 10 months. $63 to $451. You would say, oh, it's all priced in. It's all priced in. And if this is a shortage, given the increase in prices, capacity is going to come online very shortly and push this down. They don't get to keep this. Well, that's the question. Do they get to keep this? How long will it take for capacity to come online? And that's what we're going to find out here. Just to let you know, I did sell $320 puts on Micron, and I sold $470 puts on SanDisk. This is for the March 20th expiration. I measured that out using ATR, 2 times ATR. Take it off the price, and that's basically where I placed the put. It was mathematical as opposed to psychological. Market cap of $482 billion. You may say that is a lot, but if we take their price to sales and we put zero growth, we just take last quarter and annualize it. Micron has earnings coming up in a couple of weeks, by the way. But if we just take last quarter, what we saw in December, and we just annualize it, they're selling at 6.5 times sales. And that's assuming zero growth, that we're not going to have zero growth. So you could say, well, at the worst, 6.44. It's something lower because they have growth. And if we look at their PE ratio with zero growth, it's 12.7 times. So even at where'd they end? $426. They're trading at 12.7 times their forward earnings with zero growth, assuming zero growth. Well, they don't have zero growth, which means that PE is even lower if I used a forward multiple as opposed to just taking last quarter and multiplying it by 4. Volatility, it is a volatile stock. Average true range, this is dailies, 3350. So 2 ATR based on the price brings you down to 360. 50-day moving average is 346. I went below the ATR when I did it. We were sitting somewhere down around here, so I ended up at 320. 200-day moving average is 200. 100-day moving average 281. Q2 guidance revenue of $18.7 billion, guiding gross margins of 68% for memory. If you have any familiarity with memory, those margins are unbelievable. 68%, unbelievable. EPS 842. And that's where I just said, okay, well, 842, let's figure out what our, this is for the quarter. Let's just say zero growth, annualize it, and figure out what PE we are. It's high bandwidth memory, all sold out for 2026. It doesn't have anything extra left to sell. It is forecasting to 2028 compounded annual growth rate on the high bandwidth memory total addressable market, 40%. This is annual growth rate to 2028, 40%. Was about $35 billion in 2025, expected to be $100 billion in 2028. Now, facilities can make high bandwidth memory, or they can make DDR. DDR is used for the PCs that you buy. You can stick an LP in front of it. That's a low power DDR. That's for more mobile devices. And there's also DDR for data centers, which is higher capacity and more energy efficient. About 70% of all capacity in 2026 is going to be directed towards data centers, and that is in server quality DDR and in high bandwidth memory. But there's a bit of a problem with this now. There is the trade-off if you're moving from DRAM to high bandwidth memory. To make 1 gigabyte of high bandwidth memory will cost you 3 to 4 gigabytes of DRAM in the capacity that you lose, just because of the resources required to make 1 gigabyte of high bandwidth memory. So if you're switching a lot of your capacity to high bandwidth memory, you have a ratio of 3 to 1 or 4 to 1 that you give up in traditional memory. 3 to 1, if you're looking at DDR5, the trade-off is typically 3 to 1. Micron cites 3 to 1. However, future generations will require more, which means you have to give up the capacity of 4 gigabytes of DDR for 1 gigabyte of high bandwidth memory, and there's only so much capacity in clean rooms. So you can see how quickly, with this big move to high bandwidth memory, how quickly it's starving the DDR market. AI PCs, you also have this shift now from your traditional PC to an AI PC. And an AI PC means it has the capacity to be an edge computing device for an AI model, which a lot of the inference of the AI model is downloaded to the computer itself to do it there rather than sending a request to the server. 16 gigabyte has now become the standard, which is either LPDDR5X or DDR5. The LPR DDR6 is the next generation, 50% higher performance plus energy efficiency. There's where you're starting to get big shortages because most of the memory manufacturers, given the smaller capacity, are doing the logical thing, saying let's go for the highest margin stuff. That is high bandwidth memory, and that is server DDR. All you people with mobile devices and PCs, you're going to pay. And there is one particular memory, DDR4, that is being discontinued. Yet there's a bunch of devices out there that rely on DDR4, and this is becoming, there will be at some point no supply at any price, which is going to force an upgrade cycle to a lot of things out there that have to that cannot use DDR5, that rely on DDR4. So this is a big deal. January 16th, $100 billion super fab, Micron cut ground. They're spending $200 billion in the U.S. $150 billion is actually infrastructure. $50 billion is R&D. Their big super fab in New York had their groundbreaking event on January 16th. In production by 2030. Don't look for any relief for another 4 years. In production by 2030. Singapore, $24 billion for wafer production. They expect it to start incrementally getting production out by the second half of 2028. 2.5 years away. This 24 is being spent over 10 years. SK Hynix and Samsung are the other big two. They're also looking at putting in some capacity. We'll look at how we got here. And how come we don't have the facilities? That is a result of the last down cycle in memory, where a lot of these companies lost money and they said never again. So they're spending money on increasing capacity, but no meaningful capacity is going to be around for another 2 years. But you have AI growth that is still accelerating, mostly on the consumer side, mostly in the usage of AI, which requires more and more investment in those facilities. You have the end of DDR4, which is going to require an upgrade cycle, and more DDR5, DDR6, which there is no supply of. So the big question for all of these valuations is this a 2 or 3 year thing where they get to harvest a bunch of cash and then they return back to the low margin business they had? Or is this a multi-year thing that's going to continue on for a while? So let's look at our story. Okay, let's go through a presentation here. I am using Nano Banana from Google to get this done. I give it a bunch of information. I say I need a graphic for this, and I am doing this in PowerPoint, so the writing I have is limited to what I have within PowerPoint. So those are the tools. What is DRAM? We're going to go through what is DRAM, what is NAND. We're not going to spend a lot of time on this. Dynamic random access memory. It is the working memory of the computer. Dynamic because as soon as you turn off the power, you lose everything that is sitting in DRAM. If you want to store anything, you send it to flash memory, which we'll look at next. Forms of DRAM. DDR4, DDR5, we're going to see later DDR4 is being discontinued. There is an end date in that. That goes into your PCs. Stick an LP in front of that to get low powered. That goes into your mobile devices. Server DRAM and high bandwidth memory. This is where everything capacity is shifting over to these, because these have very high margins. These are lower margin. Paradoxically, what you're doing by doing this is creating this as high margin, especially DDR4. DDR4 now sells for more than DDR5, simply because it has an end date. So it is being discontinued. The money is up here. I really wish Nano Banana would have done better on these charts, but you can see, like, it's a really great graphic, but we still see a problem. There's servers and data centers. There's servers and data centers. This should be PCs. This should be mobile. This should be data centers over here. And then it didn't carry the coloring over to the other pie chart. And this is where you have to look at the output and you have to say, okay, let's modify this, modify that. But here's the problem with this Nano Banana and Gemini stuff. If you try to modify one thing, it'll change a few other things. And then suddenly, instead of you pull at one little thread and the whole thing unravels, suddenly there's 3 or 4 things you got to fix. And then you tell it those 3 or 4. Now there's 5 or 6 things. It's always better just to start over and in your prompt be very clear that it should carry over coloring if it's using any pie charts. But we could just see very quickly here, this blue area here, this 70% of all capacity is going to be directed towards server DRAM and high bandwidth memory. And PCs and mobile devices are simply going to have to scramble for whatever supply it can get. Highly concentrated market. The big three. You have Micron, Samsung, and HK Hynix. We're also going to talk about SanDisk, but that's not in the DRAM section. Let's see if we can get this to move to our next screen here. There we go. What is NAND flash? Well, if you want your data to continue to survive, that is where you put it. It is permanent storage, not dynamic storage, non-volatile. NAND is not AND gate logic. It's not AND gate logic, N-A-N-D, NAND. Vertical stacking, 20 layers. So this is how it's being made now. So rather than wafer, they're all being stacked on top of each other, and then you have these connectors that run through all of these layers. Dynamically higher density without shrinking cell size, because you're pretty much at the lower end of the cell size. You have to stack them. Replaces hard disk drives in most applications. And we have it here by major market. There is enterprise and data center. You need far more permanent storage for data centers. And we're going to see later on, SanDisk has already said, listen, our 2026 capacity, it's all sold out. And quarter over quarter, they've raised their prices 100%. And much like memory, there is no relief in sight just yet. So what is going on for mobile and for desktop? Well, they have to fight over a shrinking supply. You do have reports of some lower-end handsets being made, instead of with 8 gigabytes of memory, now down to 4, and with less storage on them, only because the cost has jumped up so much that rather than increase their price, they're decreasing the capacity of the memory, both the volatile and the permanent memory they have within the device. Okay, let's look at high bandwidth memory. If we're look at a DDR5 module, here's your CPU, and it has a certain interface. Memory can transfer between, or data can transfer between memory and CPU at a certain speed. Move over to high bandwidth memory. The bandwidth roughly 10 times what DDR5 offers. However, it is resource intensive, complex stacking and bonding, lower yields, consumes more wafer capacity, and it's about 4 silicon wafers for 1 gigabyte of high bandwidth memory versus DDR. So there's your wafer, and there is your memory module. Once you get to high bandwidth memory, wafer, there is your module. Hyperscaler demand for AI GPUs fuels the high bandwidth memory shortage, driving up all memory prices. Now, when you're faced with a shortage as a buyer, what do? If you feel there's a looming shortage coming on? You over-order. Well, guess what everyone does? Everyone over-orders, which causes the shortage to be even worse, which squeezes that price even higher. We'll talk about that a little later. Here are your players: Samsung, SK Hynix, Micron, and SanDisk. I am playing the Micron angle and the SanDisk angle. SanDisk is all NAND. That doesn't mean that it doesn't exist in the other. Samsung has NAND, SK Hynix has NAND, and Micron has NAND. 32% of global output is the leader with Samsung, 19% SK Hynix. Meaningful enterprise share, I think it's quite low actually, but it says meaningful. And for SanDisk, it's nothing but NAND. I'm going to just change my pen to see if I can get something to write on these screens better. 2026 outlook. NAND output fully allocated, already gone. Don't even call us. We're not even picking up the phone. So Q is already being determined. P is the wild card. That is price, and they've been raising their prices quarter over quarter for the last quarter, almost 100%. And what is going on with these other ones is they are moving some of this DDR capacity from servers and mobile, some of that capacity for clean rooms, over to high bandwidth memory, and also lowering capacity in their NAND facility as well, and they're moving in this direction here. So you're getting more of a shortage over here, and a shortage in NAND. Now, the shortage in NAND isn't as bad as the shortage in DDR. We'll look at some forecasts from Goldman Sachs, but no relief basically being forecast till 2028 on the pricing. And even when you get to 2028, the question will be, does the demand, if you're going to have robots, if you're going to have AI applications, if you're going to have consumer devices that have AI embedded in them, does the demand at that point grow faster than the supply capacity that is being put online? If that's the case, this continues on. How do we get here? 2022, 2023 memory industry downturn and the response, crisis, cuts, and consequences. So during the pandemic, you had this big demand. Oh, let's get devices, work at home. So you had this device that drove the price up, which drove capacity up. The demand went away as capacity came online, and boom, down you came. DRAM contract prices, 50% drop 2022 to 2023. NAND, 60% drop. And all three of them started showing losses. SK Hynix recorded quarterly loss greater than $2 billion. Samsung's first operating loss in 14 years. Tens of $1 billion lost collectively. So what did they do? Production cuts. Let's cut production. CapEx was slashed, equipment was idled, and this doesn't just come back online. 2023, you stabilized the market. The price began to stabilize. Inventory began to stabilize. They started to return to profitability. And bang, what happened is you had AI hit really bad. So you had massive capacity reduction and AI hitting at the same time, which needed massive increases in memory right when all the others said, well, we don't have the space. Sets the stage for future supply constraints. The AI spark hits dry tinder, the great semiconductor pivot. Now I give, just in case you're wondering about the graphic, how do you describe this? It's an banana. I don't. I say I need a graphic for the following, and I put the text that I need in quotes. It then takes from that the context of what I'm talking about. Since I'm talking about memory and DDR and NAND, it probably says, oh, that's pretty futuristic, and creates something that looks kind of futuristic. Early mid-2024, reduced production, depressed wafer starts, deferred expansion. Manufacturers spent 12 to 18 months cutting output. Supply chains were lean, long ramp-up times. I'm going to change my pen color again. The trigger, AI demand explosion. Unprecedented memory demand for high bandwidth memory, for server DDR, enterprise NAND. Massive memory intensity per unit. Hyperscalers race to deploy AI infrastructure. Memory requirements per AI server are multiples higher. The pivot and shortage. The companies are now pivoting towards the high segment margins, which is AI and enterprise. That together amounts to 70% of all capacity is now directed towards there. Prices are still going up over here. Consumer legacy. Look at that. Nice empty shelf. That is true. Structural shortage. Extended lead times. Limited capacity funneled to high-margin AI products, high HBM and DDR5. Consumer market stars setting the stage for a 2025 shortage. Let's look inside an AI server. We'll compare it with a traditional cloud server over here. Once you move to the AI, look at that 6x DRAM multiplier. At the GPU level, you have high bandwidth memory. 1.5 terabytes per server node. And all of these consuming 4 times the wafer capacity of DDR. At the system level, DDR5 DRAM, which is server DRAM, 1 to 4 terabyte system of DDR5 versus 128 to 512 gigabytes typical. 128 to 512 in a server, 1 to 4 terabytes of DDR5 in an AI server. At the storage level, NAND, multiple terabytes per node, petabytes in cluster aggregates. Hyperscalers building thousands of AI racks simultaneously equals immense demand on memory supply chains. The memory demand multiplier, and it's not just what we have today, it's what we have moving forward. Foundational models, expanded parameters and context, massive models, all of these, as you go from model to model, more memory at each stage along the way, larger nodes.
plus larger context windows, plus RAG databases, increased HBM and system DRAM demand. The hardware evolution, NVIDIA A100 to the H100, the H200 to the B200, all of them require increasing amounts of high bandwidth memory, multiples. Content per GPU, every step up multiplies total HBM demand at scale. Workload shift, training versus inference. For training, it is sporadic. So you train for a while and then it's over. But inference, 24 hours, that's ongoing. There's your consumer sitting here. So you have a shift to sustained consumption. Put them together. Model growth, hardware content, workload volume, up it goes. DDR4 endgame. You have a bunch of legacy systems that use this. I have to change the color of my pen because it's got a lighter background. Enterprise servers, industrial controllers, automotive systems, point-of-sale terminals, medical devices, networking equipment, hundreds of millions of devices in active use. And they cannot use DDR5. They're using DDR4. It requires a change in the hardware itself to get it. It's a production wind down. More capacity is being sent to DDR5 and high bandwidth memory. You have a situation now where DDR4 is now more expensive than DDR5. Usually older generation memory sells at lower and lower prices. This is selling at higher and higher prices. You got a potential crisis looming over here, and can anyone say the word impairments for all of the companies that have these devices or that have these this type of hardware? DDR4 supply is falling faster than DDR4 demand. Hundreds of millions of devices in the installed base still require DDR4. Enterprise servers that were deployed before the DDR5 transition, industrial controllers, networking equipment, automotive systems, medical devices, point-of-sale terminals, many of these cannot be upgraded to DDR5 because their hardware platforms do not support it. For the operators of these systems, DDR4 is not a preference, it is the only option. And the memory makers, the big ones, have said that's it. There is an end date and there'll be no more. So all of this stuff over here is going to have to, over the next 2 years, migrate to a system that holds DDR5. And what we're going to have here is accelerated, as we see here, accelerated end of life. That's an impairment. So we have that coming up in the future. Let's move on to the next one. The NAND parallel. Older nodes are retiring. I got to change the pen again. Older nodes are retiring. Focus on the newer nodes. Aggressive transition to cutting-edge nodes. Older nodes retiring faster than anticipated, reducing consumer-grade supply. Disproportionate allocation. More is going towards enterprise use. This is their AI data centers. Less is going to the consumer, so these prices have just been going straight up, as you see here. Fabrication plants at full capacity. 2026 output spoken for, doubling enterprise SSD prices. Enterprise, double, quarter over quarter. Demand, here it is, demand greater than supply. Demand at any price exceeds supply. And you need it. You want to build a data center, you have no choice, you need it, and where are you going to go? Your typical suppliers down here, Samsung, SK Hynix, SanDisk, they could choose to flood the market. They could just say, let's ramp up production now, let's go, but they're not. Prioritize margin stability. Manufacturers scaling back expansion despite rising prices. Once you get them used to certain fat margins, they're not going to want to go back. Actively maintaining shortage to prevent another downturn and ensure profitability. Actively maintaining. Let's look at typical cycles. Cyclical shortage versus current structural shift. Typical cycle. Demand surge. You got a bit of a supply lag, time to build out fabs. You get some price spike. You get capacity investment. Market rebalances in 1 to 2 years, and down comes the price. And so you have this cyclical pattern in memory prices. The thinking here is this is more structural, AI driven. You have a sustained AI build out, multi-year capex, growing models, no plateau. The supply response structurally different, new capacity oriented towards high bandwidth memory and enterprise memory, flat supply curve for conventional memory, self-reinforcing talent, R&D, management focus, a high margin AI, conventional memory becomes lower priority, industry concentration, no competitive cavalry. There's three. We're going to look in a few minutes at what's going on in China. Reinforcing incentives, economic incentives are reinforcing the allocation, not correcting it, not a traditional cycle. A critical resource reallocation driven by durable margin difference. Let's go here. DRAM pricing. Look at this, 2025 to 2026, 176% increase year over year, and I do have to change the color of my pen again. Thank you, Nano Banana. 176% increase 2026 forecast. Segment level breakdown, Q1 2026, quarter over quarter increase, PC DRAM 105 to 110%. Server DRAM up 90%. Mobile DRAM up 90%. DDR spot prices 4x, quadrupling 4 times. Q1 2026 contract price forecasts. Original forecast was for an increase of 55 to 60%. This is from TrendForce. Great data from TrendForce, but it is a lot of it is behind a paywall. The original forecast was pricing was going to increase 55 to 60%. They've revised that to say no, it's going to have to increase 90 to 95%. Samsung, SK Hynix, Micron are all rejecting long 2 to 3 year agreements, insisting on quarterly contracts. Think about what that means. They want exposure to the floating price of HBM and DDR5, anticipating stepwise price increases through 2027. Stepwise price increases. 12.7 times PE, and I said G equals 0. Does that sound reasonable to you? Hoarding behavior makes it worse. Preemptive stockpiling deepens the shortage. The cost pass-through. RAM costs double from memory manufacturers. So telecom, I got to change my pen here. Give me a second. Telecom, 5 to 10% equipment price increase. The cloud hyperscalers, unexpected 10 to 15% cost variance. So prices for mobile phones, prices for laptops, iPads, computers, they're all going up. The CapEx budget for everything that has been announced will be eaten up more and more by memory. Interest rate is not going to solve any of that. So you're going to get inflationary pressure from that, but that has nothing to do with the level of the interest rate. Make the interest rate higher, you just make things worse. Make the interest rate lower, it's not going to change anything, higher or lower, which means it should be removed from PCE and from CPI. If it is interest rate insensitive, it should be removed. Let's look at China. CXMT. Faster technical progress than many Western observers expected. In fact, so much so that there was an investigation opened, I believe, by Samsung, saying there's no way they could have made this kind of progress without some inside information. Some of our IP is in this shit. Some Samsung employees have been arrested for sharing trade secrets with Chinese companies. DDR5 chips, data transfer rates up to 8,000 megabits per second. This is lower than what Samsung is able to do, but still pretty impressive in 16 and 24 gig capacities. They're low power, almost at 11,000. Speeds are competitive mainstream offerings from the big three, achieved without access to leading edge fabrication tools, but there is a question mark in there. Maybe you don't have leading edge fabrication tools, but you might have had information. Technological gap between China and South Korea in the general DRAM market has narrowed to less than a year. Their target is to mass produce domestic HBM3, high bandwidth memory 3 chips by the end of 2026. The industry is on 3E and 4. Chinese HBM will likely trail the latest HBM3E and HBM4 designs from the big three in bandwidth and density. It may be sufficient for domestic AI deployments, creates a difficult trade-off for Western policymakers that if you deny China access to certain things, they will find a way around it. So if you allow them to have these tools and compete, you may be helping them close the gap faster. Further tightening export controls accelerates China's push towards self-sufficiency, while relaxing them eases global shortages but undermines the strategic rationale for controls in the first place. And in NAND, this is in DDR and HBM. Let's look at NAND. YMTC, 13% NAND market share. 270-layer NAND is approaching Samsung's latest 286-layer product. Constructing a third fab in Wuhan that will come online around 2027. Roughly half of its planned output expected to be dedicated to DRAM rather than NAND. So there is capacity in China, but it's not clear whether or not that's ever going to find its way out. Micron, aggressive. I got to change my pen here again, not a white. I got to have a chat with Nano Banana about this. The American bet. The other two, Samsung and HK Hynix, are South Korean. Micron is your American bet. Aggressive HBM4 production. They have about 11%. They're trailing both their Korean counterparts. End of 2026 target of 30%. And they've Clay, New York. That's where they're going to put the big facility we talked about earlier. And Boise, Idaho, they're accelerating $1.2 billion federal reallocation, fast-track HBM4 production. They expect this sometime in 2027. They do have international investments, Singapore and Taiwan, creating roughly about 90,000 U.S. jobs. High bandwidth memory in the U.S. is being classified as a strategic national asset. And they've discontinued the Crucial brand, which was a consumer memory where, have you ever gone into those stores where you can buy a box, buy a motherboard, buy a CPU, buy a hard drive, go home, build your own computer, the do-it-yourself sort of avenue? This was a sort of a staple in that particular market. 2025 revenues, $37.38 billion. 2026 forecast approaching or exceeding $70 billion. Remember, we looked at price to sales assuming G equals 0. That is not a G equals 0. We were at a low 6.44. This is not a G equals 0. So those low numbers are even lower when you think about it from a valuation perspective. Gross margin, 68% in memory. Unbelievable. 2026 CapEx ramped up to about $20 billion to fund their expansion. How long is this going to last? We're going to look at near term, mid-term, and long-term. So the near term, 2026, for the next year. If we're going to play this, are we going to be blindsided in a quarter when suddenly all this capacity comes online? Fixed supply, sold out and constrained. I need a new color. Let's go with black again. Here we are. Sold out and constrained. DRAM capacity sold out. All three major DRAM manufacturers stated 2026 production capacity is effectively sold out. SK Hynix, Micron, and Samsung. NAND capacity sold out. No new volume capacity in 2026 for both NAND and DRAM or HBM. So zero help here. Accelerating demand, hyperscaler CapEx surge projected to reach $650 billion in 2026. 75% of that, $450 billion, is directed at AI infrastructure. And I got to change the pen again. Come on there. There we go. Total CapEx growth projected $1.15 trillion, 2025 to 2027. 2026 is 650. Total $1.5 trillion, more than double the 2022-2024 spend. Major players are spending. Just Amazon, just the four companies amounted to $660 billion. So when you hear that CapEx was $660 billion for 2026, you say, wow, that's a lot. I do want to push back on that a bit while I'm here. What we have with AI is the fastest technology adoption ever seen. The fastest technology adoption ever seen must come with the fastest infrastructure build ever seen. What's making this one seem even more incredible, that's a lot of money, is that the CapEx is not spread over hundreds of companies. It's not even spread over dozens of companies. It's really compacted into about 10 or 20 companies. So not only are you contracting the amount of time over which the build-out is happening, you're concentrating the amount in 10 to 20 big companies that are doing it. So it looks like these are big numbers, but if you go back to 1999, you say, okay, .com, hundreds of companies were involved over a period of 4 or 5 years. Now I want you to compact that into 2 years and compact all that spending over hundreds of companies into 10 or 20 companies. And you'll see that, well, once you adjust for the amount of time, the speed of adoption, and you adjust for the concentration of the CapEx spenders, it's really not that big versus historical standards. Adjusted for inflation now, you have to adjust for the price level. It's really not that overwhelming. Now, you can imagine if this instead of was concentrated over 10 or 20 companies, but over hundreds of companies over 6 years, I don't think it would be that alarming. It just is happening so fast. It's a dislocation. And that's what a general purpose technology will do, what Schumpeter called creative destruction. It is going to destroy a lot before it creates value. Consequences, price surges and earnings upside, DRAM price explosion. Goldman Sachs anticipates 176% year-over-year DRAM price growth for the full year of 2026. So take the prices now, 176% year-over-year from last year. Conclusion, an arithmetic certainty. The shortage will intensify through 2026 before any meaningful relief arrives. An arithmetic conclusion derived from physical manufacturing constraints, not a forecast. There is no supply-side cavalry arriving in 2026. We are good to go, but markets are forward-looking. You can give them a great 2026, but if a bunch of supply is going to come online in 2027, those cash flow forecasts are going to drop going forward, and it will be reflected in the price. That's not reflected in the price now, so we have to say, okay, great, 2026. Where do we go from here? Show me 2027, 2028, and beyond. So let's look at medium term, 2027, the first inflection point, partial normalization. And we see here SK Hynix. Let me go to black ink again, SK Hynix. They have their plans of what they're building out. Mid-2027, they expect to have more wafer capacity. Here again on Yongjin Cluster Phase 1, target May 2027. They're packaging end of 2027. Micron, Singapore, high bandwidth memory packaging. The Taiwan fab, Boise, Idaho, HBM4 ramping. Second half of 2027 start. Samsung, again, they have some things coming online in 2027, incremental supply growth, but persistent demand drivers. Undersupply narrows, and this is Goldman Sachs' forecast. 2026, the undersupply is about 4.9%, and an undersupply of 5% is an undersupply, period. The only way for people to get what they want is prices have to go up. And some of them say, okay, well, I don't want it anymore. Undersupply, 4.9. 2027, still an undersupply, still translates to elevated pricing and constraints. So we move from 2026, which is crisis, 50 to 100% quarterly price increases, to 2027, which is structural tightness, single-digit to low double-digit percent increases. But you're still at that higher level. You're still at the higher price level. Consumer market outlook, limited relief. New capacity overwhelmingly directed at high bandwidth memory and enterprise. Consumer memory remains the lowest priority. No meaningful price relief until late 2027, at the earliest. Let's look at the bull case. We'll look at the bull case and the bear case. Structural transformation drives sustained elevated pricing and profitability. You know, I gotta tell you, I use Gemini, I use OpenAI, and I use Claude. I'm gonna tell you this now because of this little thing on the end, this site that you see. You see where it says I give it documents, some paragraphs, and it wants to say where it got all of the points from, and I tell it specifically, do not include that in the graphic. Once you and Gemini will remember for about 20 graphics, and then it starts doing it again. It forgets. I used to rank the AIs as, in the beginning when I started using it, Gemini easily number 1, OpenAI number 2, Claude a distant third. Over the last about 3 months ago, I would have said Gemini and Claude are about equal, OpenAI a distant third. Well, I'm sorry out there, Google friends, I got to put Gemini at a distant third now. Claude number 1 across the board. OpenAI agent mode, not just the regular chat, but in agent mode. I use that a lot now. And Gemini, I use it for nano banana. I'm not using it for anything really much. Even with using it for deep think, if I give the same question to 4.6, Opus 4.6, I get a better answer. So even deep think is like, this is so last year. So Google's got to leapfrog. They got to come out with something better, because if you used 4.6 and you've used OpenAI agent mode, it is great. I've just started experimenting with Claude Cowork. You know, if you lay out your work in such a way, like it does require you to lay out your work first in such a way that Cowork works. But it doesn't really work on the documents you have. You say, okay, I see where you're making mistakes. Let me go fix my document for your work process. So you have to now produce output for its work process, and it works. Sorry about the aside, but I just see the citation here, and I feel there's some value in telling you about the AIs and where they are. And again, let me stress here, if you have not given Claude 4.6, Opus 4.6 a run, give it a shot. Give the same prompt to Gemini and to Claude and to OpenAI, and you'll probably elevate Claude to number 1 very quickly. All right, the bull case, unrelenting AI CapEx spend, $641 billion, 2026 estimate, 2027, $739. We're already choking on $660. Where's the private credit market going to be at that time? Where's the public debt market going to be at that time? Increasing memory per AI system, we've already seen this moving from earlier generations of NVIDIA to the new generations. You need more high bandwidth memory, more NAND, more DDR. Manufacturing strategic discipline, this is the big one. Samsung, SK Hynix, and Micron, all of them saying, let's, they've been here before. Now they all can't get together in a room and say, hey, you know what, let's do this. No, they can't do that. But there is some game theory here in saying, well, what is the best outcome for everyone? The reason Coke and Pepsi don't get into price wars anymore is because nobody wins in a price war, and they know that. It is common knowledge. Pepsi knows that Coke knows, and Coke knows that Pepsi knows, but even more so, Pepsi knows that Coke knows that Pepsi knows that. That's what common knowledge is. It's not that I know something and you know something. Common knowledge is that I know something and I know you know something, but I also know that you know that I know it. And they all, there's only 3 of them, and they all know that. So from a game theoretic perspective, they will match each other's move. And if the first one announces, well, we'll increase capacity by this much, all of them will be constrained in increasing the capacity as well. They're not going back to the losses they had, not that early. So yeah, you have these guys working against extra supply, saying, well, we'll put out supply, but we're really going to match it with demand, and we're going to try to make sure the market is in slight structural deficit each year. 2026 super cycle, like the 1990s boom. 2027 elevated prices. 28 to 29 shortage could continue. Partial normalization only with new volume production. HBM market value, $35 billion in 2025, $100 billion by 2028. Manufacturers operating margin, look at that. I mean, this is just a graphic, but you're going from sub 40-point margins to almost 70-point margins. Sustained earnings growth drives stock appreciation. DRAM supply growth will lag demand through 2028. What about the bear case? I can see the bull case, and for 2026, it is worth selling puts unless we think, hang on, by 2028, the bear case is looking more and more likely 2026 will not hold its pricing. Both SanDisk and Micron will give up their pricing in anticipation that this is short-term. They don't get to keep all of this for multi-year periods. So if you think they keep these prices and move higher, you're buying into the bull case. What's the bear case? AI spending deceleration risk. And that is very true. You have this CapEx that you're spending, but if you keep pushing up memory prices, the hyperscalers may at some point say, look, there's no way we're going to get our money back on this. There's no way. They may actually cut back. This may actually cause the cutback. Unproven ROI. I need a better pen. There we go. Unproven ROI. There we go. AI investments may not generate durable, profitable returns quickly enough to justify the CapEx. Financial constraints. Hyperscalers face high debt. 1.5 trillion new debt projected. Capital intensity, 45 to 57% of revenue, and investor pressure. CapEx growth moderation, a deceleration from 36% to 15%. Still growing, but only at 15, a significant step down, potentially leading to demand growth falling below supply growth. There's your big thing. This is all CapEx driven. Substantial new capacity pipeline. SK Hynix is bringing capacity online. Samsung is. Micron is. It is coming online. Substantial if you have CapEx growing at 36%. But if you have it growing at 15%, it is oversupply. Largest capacity expansion in history. Risk of overshoot into softening demand. And, of course, historical patterns. We've seen this before. The claim that this time is different. Tech Insights forecast semiconductor downturn, including memory, in 2027. If the market starts to believe that, it will start to reflect it in the pricing. Price plateaued 2027, sharp decline 2028. I don't know if I would believe that. If we think there's going to be overcapacity in 2027, it'll already start to turn down, or at least we will be at the plateau of pricing right now. Potential of market oversupply, margin compression from 60 to 70% range back to the historical 30 to 40% range, significant stock correction. Which one do you believe? The bull case, where this just keeps going. This is a new operating system for the world. This just keeps going. And we haven't even seen all the AI applications. We haven't even seen all the embeddedness in hardware, new AI PCs, AI-driven vehicles. What about robots in the house? What about smart houses? What about all the devices that you buy that have no AI capacity built into them, no edge computing for AI? What about all that? Or, look, at some point, CapEx has negative net present value, and these are businesses making business decisions, and you're not going to say, let's own a market that we lose money in. Now, I want you to think of one more thing, and this lines up nicely with Palo Alto. Palo Alto had great earnings and guided their revenue to the high end of their previous forecast, but EPS came in light. Memory and storage costs. Now, if the bear case does play out, and you have all of this CapEx, and in 2020, late 2027, 2028, these prices come crashing down, I want you to think of all the impairment charges that are going to have to be recognized by all of these companies. All of that spending, and that suddenly they're not going to get the return on that, because if those memory prices come down, those storage prices come down, at the margin, CapEx is cheaper. Your ROI is going to be based on that. That previous CapEx is going to have to be impaired. That you could have a significant, not just a memory price downturn, but a significant price downturn across a whole bunch of these companies if they have to start taking impairment charges. So the world, the equity world, has to hope, really hope, that the bull case does play out, because if the bear case plays out, you could have a repeat of what you saw with the NASDAQ after the dot-com bust. Over the following couple of years, lost 90% of its value. Think of Micron losing 90% of its value. It would be a $40, $50 stock all over again from where it is now. But Not now, not this quarter. There is money to be made by trailing. I don't know that I'd be an aggressive buyer, but certainly with the elevated volatility, selling those puts at 2 times ATR on a monthly basis, I think that's easy money for the balance of this year, but I would be cautious. Oh, this time is different. How many times have we heard that? And how many times has it been different for a period of time? And then, you know what? It's pretty much the same thing that it always was. Anyways, that's our Spotlight Company for this week. That's the end of this one. Just looking at the timeline so far, I think we're over 2 hours this week. Sorry about the length.